The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. April was a month of extraordinary swings in Singapore's stock market, marked by sharp sell-offs and strong rebounds, driven largely by global trade tensions and a surprise tariff announcement from the U.S. government. Now, against this backdrop, retail investors in Singapore emerged as aggressive buyers, pouring over 1.1 billion Sing dollars into the market, particularly targeting financial and maritime stocks that saw steep declines. So which stocks were most bought and sold by retail investors amidst volatility? What insights can we draw from the sectors that saw the heaviest inflows and outflows? Are retail investors becoming more tactical, or are they exposing themselves to heightened risks? Well, to find out more, joining me now is Geoff Howie, market strategist at the SGX. Geoff, welcome back to the show.
Thanks, Hongbin. Good afternoon.
All right, Geoff, before we dive into the stocks most bought and sold by retail investors, let's talk about the overall landscape of markets back in April. How volatile were Singapore's stock markets last month? Was the extent of volatility something we've seen before?
It was definitely very notable. As gauged by the STI, that volatility got to as high as we saw back in the most volatile times of 2020. And obviously you can remember back then, global socio-economic uncertainty was really strong because of all the COVID containments taking a hold of the markets, and markets did not have much reference as to where growth would be. But at this time around, not all stocks moved the same way, because the driver ultimately was the US tariffs disrupting global trade and by extension global growth. So you had cyclicals, you had defensives over the first 2 weeks of April. For instance, Singtel was very defensive, Cetrium was cyclical. Singtel gained 2% over those first 2 weeks, while Cetrium declined 16%. That was an 18% differential between those performances of those two stocks, which are at either end of the STI performances for those first 2 weeks of April. And then when you look at it from the 14th of April through to the end of last week, Cetrium has since recovered that decline. It's generated an 18% total return from the 14th of April, mid-April, right up to the 16th of May, while Singtel has only added some 7%. So you can see how your cyclical versus defensives has worked first 2 weeks of April and then the 4 weeks subsequent. You also had safe havens in play in the month of April, for that matter. Gold price reached a record high in April of 3,505 cents an ounce. And the extent of the volatility is something we had seen before, but not all stocks were volatile. You had definitely differences between the cyclicals, like Cetrium, obviously impacted by the outlook for global trade and global growth, and Singtel was less impacted. But since then, Cetrium's outpaced Singtel, so there you go.
Retail investors poured over 1.1 billion Sing dollars into the market in April. What does this tell us about, retail risk appetite during volatile periods?
Yeah, it was definitely, risk appetite was on. Retail investors really embraced volatility with the stocks that saw the most declines. So think of it, or conceptualize that in the past 5.5 years, Singapore retail investors have been bigger net buyers in times of relative underperformance here. More net buyers in underperformance than in outperformance. So there's been around 15 billion Sing dollars of net retail buying since the end of 2019, and the least net retail buying, I think, was back in 2022. That's when the STI was a very close second to the Brazil benchmark in being the best performing stock market for that year in 2022. So, basically you've got the volatile periods. That's when retail really go to work and accumulate. We've seen similar behavior in the ETF market. We've got two STI ETFs. It took them 17 years for their combined assets under management to reach the 1 billion threshold, and then only 17 months to reach a 2 billion threshold. That was on the back of all that volatility back in 2020, and we've had volatility since. So present AUM of the two STI ETFs is in the vicinity of around 2.7 billion Singapore dollars.
Well, among the most purchased stocks were local banks, which fell by an average of more than 18% at the STI's trough on April 9th. Now, retail investors also chased heavy dips in maritime stock, which suffered heavy losses at an average, 19.8% dive. So, Geoff, why were financial and maritime stocks like, DBS, UOB, OCBC, Keppel, and Yangzijiang so heavily bought? Were these fundamentally driven decisions or dip buying psychology?
I think it's two reasons, Hongbin. Firstly, those two segments, you've got to remember, had recently led the local market. So the STI, I think, Yangtze Jiang Shipbuilding, for instance, was the STI's strongest gainer in 2024. And, of course, the banks with their 50-plus weightage in the STI led the STI in its 23% total returns last year. So context is important. They had performed well. And secondly, the volatility was not on the tariffs themselves, but on the impact of the tariffs on global trade and global growth. So international banks, when you rewind the clock, they bore the brunt of the market declines back when the US really ramped their tariffs back in the 1930s. And some of the international banks, therefore, more known to be proactive in trade finance or, based in international trade hubs, like Singapore's an international trade hub, they got more impacted in the first half of April. So there's a degree of being measured there. And at the same time, your trio of STI banks for the first half of April, that potential first order and second order impacts, the direct and the indirect, which take longer, impacts of the tariffs, they saw downward revisions to the bank target prices. So the trio over that 2-week period averaged something like 14% declines in total returns. And during that time, as I said, retail investors really embraced the volatility. They moved quickly and net bought as much as $1.5 billion in the three STI banks alone during those first 10 sessions of April. Now, as I said, that's quite considerable when you consider that ever since the end of 2019, net retail buying in the total Singapore stock market's been around $15 billion. We had that $1.5 billion of net buying in the banks just in those first 10 sessions of April. And then since then, the trio of banks, that they've averaged, I think, total returns of around 12%. Retail investors have continued to net buy them, but at a much more significantly reduced rate, I think of around 40 million net buying for the month or so. So exactly as you said, it was likely buying on the dip thinking, but also in those stocks that have fundamentals that do continue to resonate with most investors.
So, Geoff, with local banks rebounding nearly 13% after the April dip, how do you see the sector performing in the months ahead then?
Yeah, I think, important that we had the reporting just recently. So earlier this month, the trio reported that their combined net interest income for the first quarter of the year was 8.4 billion Sing. So that's the 10th consecutive quarter that the combined net interest income has surpassed 8 billion Sing. Apart from being impacted by interest rates, that net interest income can also be driven by expanding your loan books. And DBS and OCBC did maintain that their FY25 target of mid-single-digit percentage loan growth was intact. UOB made the caveat that while it's working on its preceding mid-single-digit loan percentage growth assumption, it could be subject to revision based on how the overarching tariff uncertainty obviously impacts client requirements. Another positive was the combined first quarter FY25 non-interest income did revert back to above 4 billion Sing for the trio in total. I think it came in at 4.8 billion Singapore dollars. So that was up something like 28% from the previous quarter, the last quarter of last year, on the base of the increased trading activity. So, how do we see the sector performing in the months ahead? That, as we said, that there's a number of ways to look at it: net interest income, non-interest income, and of course the NPLs ratios. And importantly, too, the trio of STI banks, they are pressing on with their capital management distribution initiatives. They bought back a lot of their shares, well, not a lot of their shares, but 550 million Singapore dollars of their shares over the first 4 months of the year. And it was interesting to see UOB, in terms of its buyback consideration, in the first 3 weeks of April, it bought back as much of its own shares in consideration as it did for the whole 2024 calendar year. So, obviously it's a very fluid outlook based on how the markets see the impact of tariffs and trade negotiations on growth is one factor. Markets have priced in or are expecting the pause on tariffs to be extended past July the 9. The Trump administration is definitely doubling down on using tariffs as a means to get trade negotiations that put more FDI into the US economy. So, this is a really fluid outlook, Hongbin.
What about your outlook for Singapore's maritime and industrial stocks, which experience both heavy selling and buying?
Yeah, that's right. And I think industrial value chains across this region, they've definitely been rewired. After telecommunications, industrials have booked the most net institutional inflow into our market this year. Samudera Shipping Line CEO, he recently bought more of his stocks He's been speaking about rising manufacturing in Southeast Asia and India, and that shift could, obviously boost demand for his container shipping, and changes in global shipping alliances can also affect routes. Bank of America survey came out last week, showed India is now the top equity market for asset managers globally, overtaking Japan. The reason being realigned supply chains. So you can see with the threat of tariffs, there's obviously more rewiring or realignment of these regional value chains, but there's also industrial automation, Industry 4 also making significant inroads into the industrial sectors and the maritime stocks with a strong engineering aspect. Pan United Concrete, it completed that 10,000-ton concrete pour, I think in just 35 hours, and that's what's soon going to be Singapore's largest building, the Skywaters, on number 8 Shenton Way, and that was achievable by an AI-powered system that helped manage their tricky logistics. ISO team is developing autonomous drones for painting and cleaning building facades. ISDN has that strategic partnership with Dafeng AI to distribute intelligent robot building solutions. So, you've got two big structural factors, the tariffs and rewiring of trade, and also the industrial automation Industry 4 really impacting these particular sectors.
Well, then, are there any other stocks that were heavily bought during this time that caught your eye, Geoff?
Yeah, by retail, net buying, Keppel was among the mix, Venture Corporation, Yangtze Jiang Shipbuilding, Capital Land Investment was there as well, Mapletree Logistics Trust and SATS. Now, the interesting thing was those 10 stocks that saw the most net buying by retail, they averaged a 14% decline. And similar, outside the STI, you had the likes of iFast, I think Keppel DC REIT, UMS Integration, Suntec REIT, they were among the stocks that were also heavily bought. So again, heavily bought did coincide with more declines.
Right. Meanwhile, telco stocks, particularly Singtel, saw the most selling, as you mentioned earlier in our conversation. Was this purely profit-taking, or did fundamentals play a role, Geoff?
Yeah, I think less impacted. That's the thing. So those 10 stocks that had the most net buying, they averaged 14% declines. The 10 that were most net sold by the retail over that first 2 weeks of April, they saw only a quarter of those declines. So they only see a quarter of the 14% declines. So therefore, you could have had rotation out of those stocks that were at higher levels into the stocks trading at sudden more depressed valuations. So Singtel really did buck the trend. It added 2%, as I said before, over those first 2 weeks. Looked possibly as a little bit more as a defensive play for institutions. And at the same time, retail might have been able to book some of the profits on the stock and rotated that back into the banks that were trading, more than 10% lower. Singtel still has robust fundamentals, going to report its FY25 results, I think, before the Thursday Open. And it's now 1 year into its second leg of strategic transformation, ST28. It has given FY25 guidance. I think it expects its earning before interest and tax, excluding all those associate contributions, to grow at a rate by high teens to low 20s. Cost savings, $200 million, have been targeted for Singtel in Singapore as well as Optus, and I think dividends from those regional associations are projected $1.3 billion. At the same time, it's also, as we know, going for growth in high tech. CAPEX, I think, $2.8 billion across 5G, cyber, digital transformation, data center, and satellite. So that's stock, as we said, most sold by retail, but still, like it was last year, most bought by institutions. Got the most institutional inflow for April, year to date, and all of last year. Also in April, Netlink, NBN Trust, and StarHub also saw net institutional inflow for April. And obviously, fundamentals may have also been playing a role in keeping that sector more defensive, and retail was able to utilise some of that for the quick fire net buying in the banks.
Right. Well, we discussed this earlier where industrial stocks experience both heavy selling and buying. Just zooming in a little bit here, Yangtze Jiang Shipbuilding and Keppel, they were heavily bought, but others including, ST Engineering, SIA, and Comfort Delgro, they were heavily sold instead. What might be the reason for this, Geoff?
Yeah, I think retail generally have a little bit more discretion in their attempts to buy low and sell high. I mean, on the retail front, there was a bout of retail net selling in the initial recovery after the first 2 weeks of April. So now looking at that third week of April, that's interesting because you saw ST Engineering, SIA, Singapore Airlines, Comfort Delgro, they were among the 10 stocks most sold by retail in the week following that 2 weeks of significant volatility. And it was over those, let's say, 6 sessions, that in the third week, spanning going into the fourth week, that the 3 stocks, ST Engineering, Singapore Airlines, Comfort Delgro, they averaged 6% gains over the 6 sessions. Now, that's not too different from the stocks that were most net bought by retail, okay? So performance-wise isn't so different, but there was one discernible difference, and that was that the stocks that were most net sold by retail over that week had averaged year-to-date gains of 4% versus a 9% decline for the 10 most net bought by retail in the year to date at that time. So what it's telling us is in that instance, there was retail net selling more on what had gained in the year and more net retail buying in what had declined in the year. So again, as I said before, looking at where the stock has been, has it been gaining, has it been declining? And in that week in particular too, that behaviour of buying more in the declines and selling more in the gains, that was apparent what happened in that particular week in April.
Right. Well, we dived into some of the behaviors of retail investors here, but institutional investors conversely appear to reposition defensively as fears of so-called catching a falling knife escalated. I mean, I think you did highlight this earlier as well. I mean, we saw a divergence between institutional and retail behavior with institutions, selling financials while retail was buying. What could explain this divergence in strategy, Geoff?
Yeah, I mean, institutional investors tend to follow performance, obviously, but obviously not all do exactly, is that they also like to deliver extra alpha to their investors. But if institutions have mandates to tranche in or accumulate in times of excess volatility, then they'll look to do so probably in those stocks that they're already holding. And also, as I said before, share buybacks really did soar in April. UOB, as I said, bought as much as $102 million of its shares between April 1st and April 21st, and that compared to the same amount, $102 million, in buyback consideration for the entire 2024 year. So, I think, typically, as we said, when we look at all the net retail flows into our market over the last 5.5 years, there's obviously been a preference to sell in strength or come in and buy more in times of excessive volatility or depressed prices, quick fire moves by retail, and then institutions possibly look to be a little bit more systematic and following performance in the market. But it's up for different interpretation and so forth.
Well, so Geoff, do you think retail investors, so-called caught the bottom effectively in April, or were they too early in buying the dip?
Well, as I said, markets have been very fluid but measured. Markets expect that July 9 tariff pause to be extended. You can see that the US is constructively looking to get better trade deals that fortify their foreign direct investment and foreign investment into the US, and obviously look at providing more fiscal buffers that help reduce their fiscal deficit and their trade deficit, which over time will also help reduce their overall national debt position. So that's one thing you got to watch closely. You also got to watch what's happening in the rest of the world. Central banks all the way from China to the UK have been lowering their rates to help support growth. China is also pursuing significant demand-driven consumer sector stimulus. That's different to the past where it's been more supply-driven consumer sector stimulus. And look, when we go back to the tech sector overall, the US tech sector, it did have a good earnings season for the first quarter, a lot more beats than misses. So I think overall, Hongbin, following that, all these recent downward revisions to global growth, the risks are on the downside, but global investors have also increased focus on economies that either have robust domestic demand or the means to support domestic demand should those global downside risks eventuate or the high tariff scenario eventuate as well. And that's obviously keeping Singapore very much in the spotlight. So let's wait and see.
Definitely. Well, thank you so much, Geoff, for your time and your insights today.
Thanks so much, Hongbin.
Thank you. That was Geoff Howie, market strategist at the SGX. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.